Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and one of the founding partners of the Dividend Kings. You know, everybody's looking for good investments that can make them a lot of money, and I get that and I understand that. However, one thing that concerns me is that, I've talked about this quite often in recent articles and videos that I do on my YouTube channel. I do believe that the market is very, very expensive right now. And perhaps the one area of the market that maybe is most expensive is the tech sector. And yet we all know that technology is where the growth is. There's no question about that. But here's what concerns me. It's very easy to get caught up in the fact that these industries are growing, and some of the best. I'm going to talk a little bit about Microsoft and Apple in this video, but I'm also going to talk about an attractively valued stock that I found in the tech sector that I think can participate in the growth that companies like Apple and Microsoft are producing, because I'm always looking for growth at a reasonable price. I'm always looking for that proverbial margin of safety. And the problem is, I want to remind everybody that all bull markets end with a bear market, and we're in a major bull market now, and all bear markets eventually end in a bull market. Now, the good news about that is bear markets tend to be much shorter than bull markets. Bull markets last a long time. This current one we're in is one of the longest lasting, but it will end. And consequently, if you're making your judgments based solely on stock price and stock price movements, you could be in for trouble in the future. Now, what that future is going to be, is it going to be next week, next month, next year, in the next 2 years? Nobody knows. It's everybody's guess is what's going to happen there. But the reality of it is eventually all bull markets end with a bear market. So let's go ahead and look into some of these technology stocks. And what I've got as a bonus for, I found one that I think is going to grow faster than what most people are expecting technology stocks to do, and yet it can be bought at a reasonable price. So let's go ahead and get into the video, if you will. I put together what I called I called this a little portfolio I built here with 3 stocks: Apple, Microsoft, and a company called Silicon Motion Technology, which is actually Hong Kong based, but also has offices in the United States and other countries. And it's a very interesting company. According to them, they are the global leader in supplying NAND flash controllers for solid-state storage devices. They also supply solid-state device controllers more than any other company in the world for servers, personal computers, and client devices, and are the leading merchant supplier of eMMC and UFS embedded storage controllers that are used in smartphones, Internet of Things devices, and other applications. They also support customized high-performance, hyperscale data center and specialized industrial and automotive solid-state solutions. Their customers include most of the NAND flash vendors, storage device module makers, and leading original equipment manufacturers. By the way, last I could check, they serve every smartphone maker excluding Apple, but every one of the other top 10. So it's participating in the growth. But here's what I want to point out. This is a rather small company. It's $2.2 billion in market cap. That's important for a reason. Yet when you look at Microsoft at 1.9 trillion and Apple at 2 trillion, these are mega huge, companies. Now, Microsoft and Apple trade at extremely high PEs, 27 times earnings, blended earnings for Apple, 33.5 times earnings for Microsoft, but yet Silicon Motion Technologies is trading at 15.86. Here's what's really interesting. These behemoths, the estimated growth is an extraordinary 10.39% expectation for Apple. That's extraordinary considering their size. For Microsoft, it's even bigger at 12.72%. Again, extraordinary for its size, but yet Silicon Motion, the little guy here, is expected to grow at 18%, which, by the way, makes sense because it's a heck of a lot easier for a $2 billion company to grow fast than it is for a $2 trillion company. They call that the law of large numbers. So what I've got here is I've got dividend yields that are very, very low on the behemoths, and I've got over a 2% dividend yield on Silicon Technology. So let's get into these. Let me make a couple of points that I think are real important. Number one is, this is Apple. I'm going to look at all these stocks from the 2011 or just late 2010 timeframe. And what you've got here with Apple is just probably my favorite company on the planet, okay? Tremendous growth story. Started paying a dividend, back in 2012. So it's now become a dividend growth stock as well as a growth stock. Tremendous growth record considering its size. It's grown at 19.5% over this time frame. So I'm using the P equals growth rate formula here, and this is a PE of 19. But I do want you to notice for most of this time frame, Apple was awarded a 15.9 is the blue line here, but you can see there were times when it was below that. Now here's the point I want to get across. If you wanted to own Apple, you needed to buy it when the price was attractive and reasonable, where there was a margin of safety built into the valuation. This is not a good time to buy Apple. Is this a time to sell it if you already own it? Maybe, maybe not, depending on what your cost basis is and where you bought it, because I do believe in being a long-term owner of these things. And if I'm looking at the future for Apple, their long-term growth rate is expected to be about 14%. But if it trades at a 15 multiple, and I want to be clear, like it has historically here, the reality of it is the pure math of that is that your rate of return would be a negative rate of return over the next 5 years if this stock corrects to the mean. Now, the normal multiple on Apple over this time frame has been closer to 17. So if I take that same growth rate and I put it at the 16.5 to 17 range, I start to get where maybe even 18, where I'm breaking even a little bit, assuming the stock reverts to the mean. So the point is, it's not buyable now, and whether you want to sell it or not and look to buy it again at some other time is strictly up to you. But I also want to point out the stock has been kind of treading water here for the last, several months, and I think that's strictly a function of its overvaluation. I'm going to say it again one more time. I love this company. It's AA rated. It's got a little bit of debt. That's something that we'll talk about here in a moment, but it's a great business. So when I go and look at the actual attributes, now there's some offshore cash that Apple has and so on, but I'm looking here at total debt and cash equivalents on the fund graphs, the financial underlying numbers. Apple has a tremendous amount of cash. They have over $90 billion as of September 2020 on their balance sheet, and that number has shrunk a little bit here in recent quarters, but that's an enormous amount of cash. But the company also has a lot of debt. Now, I will make this point. Most of their debt is long-term. That's the blue line on this graph. So they have plenty of cash flows to handle that debt. That's something else I think you want to take into consideration, that, if you look at their free cash flow generation, Apple generates a lot of free cash flow, and they also generate, obviously, an enormous amount of operating cash flow. So, Apple's a cash cow. I mean, there's no question about it. Love the company, but I don't like the valuation. Let me conclude my Apple discussion of saying this, repeating what I already said. If you're going to buy Apple, you should have bought it when it was inexpensive. Now is not the time to buy it. Now, you might want to continue to hold here, or it might even make sense to come out of it and look for a better re-entry point at a later date. That's your decision. I'm not going to make that for you. Moving on here, let's look at Microsoft. Once again, it wasn't that long ago when you could buy Microsoft at a 9 and 10 multiple. What a tremendous time to buy this company. They've grown beautifully as a business since that time. But the point is, people have gotten excited about it. It's, hype in this area. This is, where in the short run, the market's a voting machine. In the long run, it's a weighing machine. Obviously, Microsoft's stock price has been driven to incredible heights here. As I said earlier, the blended PE is over 33 times earnings. That's an earnings yield of less than 3%. One of the greatest companies on the planet, just like Apple was, forecast to grow at around 12 or 13% a year for the next couple of years, perhaps a little bit lumpy. The average growth is 12%. If I combine the two and look at near-term estimates plus long-term growth, company's got a lot of growth potential. But again, if I look at this company from a long-term historical point of view, there was a lot of times I could have bought it at less than a 10 multiple. In fact, if I really extend it out here, I had years where I could have bought it at 9 and 10 times earnings. And the last time that it was trading at this kind of a PE, in the mid-30s, the company was dead money for years and years and years. Great business. Don't get caught up in these price, movements, because all bull markets eventually end with a bear market, and the reversion to the mean is inevitable. Dividend Sensei has talked about, studies that have been done saying in 11 years, fundamentals will absolutely rule. But here's a case where the stock has been running on, rarefied air, if you will, for several years. Don't deny that. Don't doubt that. Had you bought Microsoft when it was inexpensive, what a tremendous boon you've got here. But I also like to refer to these as false profits. It may be time to take money off the table. That's strictly your call. You've got to make that decision. What I'm pretty certain about, though, that I'm not going to equivocate on, is this is not a time to be buying Microsoft, okay? Because you could get some short-term gain possibly, but you could also face some very real long-term pain. But yet, so this is, Microsoft obviously in the Internet of Things, the cloud, they're involved in, PCs, they're even involved in other types of hardware, tremendous company and pretty well diversified as a technology stock. But now let's move on to the one that I want to feature. This is Silicon Motion. Now, it's an ADS. It's headquartered primarily in Hong Kong. Its growth has been over 20% over the last same time frame as I was measuring Microsoft and Apple. You can buy this stock at a 12 and 13 multiple, currently trades at a 15 multiple, so it does trade kind of at a discount. But here's the key point. This company is expected to grow at 18% a year. So even if I, price it at, below its historical norm, I'm using 12.67 here because it's on the graph. That's 11% at a 14 PE at 17% annualized. And at its growth rate, it would be a 27% annualized. So I've got a modest margin of safety here. I've got a much higher dividend yield, 2.16%. And let's look at the balance sheet of this company real quick. Company has an enormous amount of cash and virtually zero debt on their balance sheet right now. So they've got an extremely strong balance sheet. The company is, again, according to their own words, are the global leader in NAND flash controllers for solid-state storage devices, and they're selling, products for all the technology going in automobiles and smartphones all over the world, excluding Apple right now. But it's got tremendous growth historically. It's got a tremendously strong balance sheet, and the company has also performed extremely well. If I look at its performance over this time frame, it's certainly not shabby. $10,000 going back to December 31st of 2010 would have grown to $151,000. That's a 29% capital gain. Plus it paid out $18,000 of dividends compared to the average stock only paying out $3,200. Had tremendous historical performance going for it. Now, if I go back here and look at Apple and look at Apple's performance, it also had great performance. A lot less dividend income, interestingly enough, slightly less capital appreciation, but still Apple's been a 27%, annualized rate of return. But Apple had to be massively overvalued to achieve that. If I would be valuing Apple from fair value to what I would call fair value here, and I'll be generous, then that's dropped it down to about a 24%. So a lot of that, return is built in on this overvaluation here. Same with Microsoft. To go back and look at Microsoft's performance, it's also generated almost 25% annualized gains, paid out $6,500 in dividends for a 25% annualized rate of return. But when I compare that to Silicon Motion Technology, 2 or 3 times the dividends that the other two have paid, stronger capital appreciation, and the stock remains undervalued at this point in time. It didn't have to generate that. It generated it by growing faster than the other two. So this is one that I would put on your research. If you want to invest in tech, I just don't believe you have any reason to go out and pay these high valuations that some of the best tech stocks out there. There's always value to be found if you're willing to look. I really like this little company. I don't own it at this point. I'm looking at it. I'm doing my research on it now, and I've gotten really some pretty good research. A lot of firms are already putting price targets on it at $80 to $100. That would be consistent with what it technically would be worth if you were pricing it based on, what FastGraphs is showing here on these as these target rates of return. I think it could even be higher. There's your $92 value if it traded at an 18 multiple. And again, 80 to 100 is what a lot of these guys are saying. So this is one I think you ought to take a closer look at. It's a very, very interesting company. It was founded in 1995. And again, it's a leading developer of microcontroller integrated circuits for NAND flash storage devices and original equipment manufacturers and others. I have only begun doing the work on it, but I like what I see so far. I love the balance sheet. I love the cash position. I love the growth. I love the growth potential. And by the way, this company has grown significantly through acquisitions, and they appear to be very adept at that. So that's something else that I think you might want to look into when you're doing your research. Anyway, this has been Chuck Carnevale, producing Silicon Motion Technology as an attractively valued technology stock that's poised to participate in all the growth that the mega stocks like Microsoft and Apple are going to be generating, but you can buy it at a much better price. I hope you liked this video. If you did, ring the bell, give me a like, subscribe to the channel if you haven't already. I look forward to talking to you guys again real soon.